Hello, welcome back to You Heard It from a CFP. My name is Matthew Coyle. Today is June 28th, 2021. I'm the head CFP here at ACG, and today we're going to talk about the markets. Since we are almost in July 4th, that means we're midway through the year. Where do we stand? What's working out there? What are people talking about? And where might we be going for the remainder of the year? So let's dive in. You might find it interesting. Okay, so it is midway through the year. We are almost at July 4th, and probably the last thing you're thinking about is your money or the markets. But what's interesting is that if you look at some of the things that we're looking at, you might leave this video a bit more optimistic than you started. Let's put up a few and we'll talk about it. Number one, I'll put the chart up here, is inflation. Everyone's talking about inflation. It's the topic du jour of 2021 these days. Inflation as measured typically excludes things like food and energy, and this is the favorite way of the Federal Reserve measuring inflation. We typically strip core energy and food prices out because they're the most volatile. They tend to skew the averages, and we don't like to include them. So many things that would be in this would be household prices, household goods, home prices, car prices, things like that. And this chart by itself is not particularly interesting or surprising because we've all experienced that in the last few months. Now, what is interesting, and I'll go to the next one, is excluding transportation. So if you've gone to a car lot these days, first of all, you've noticed a lack of inventory. I was traveling recently and I noticed most car lots were almost empty, or at least they'd moved all their inventory to the street to make it look full. If you strip transportation, things like airfare tickets, used cars, new cars, anything transportation related, if you take that out, inflation isn't actually that bad. Now, it's tough to say to someone who has to go to the store and buy food every day like we all do, but those prices certainly are rising. But if you strip transportation out, that's the interesting thing, is that inflation looks a lot tamer than it's actually coming across as when you first give it a glance. In fact, used car sales alone accounted for 1/3 of the increase in core inflation over the past year. So very interesting chart. Sometimes things are not always what they seem. If you strip transportation out, people are definitely getting back out there buying tickets, buying train tickets, plane tickets, buying used cars. Clearly that is going on. But particularly interesting is that chart there. Stripping that out, it's not as runaway as you would think it would be. So very interesting there. Next chart I would put up there is new single family homes. Now, if you've shopped for a home lately, you know the prices are rising. You know you're competing against all cash offers. That by itself, I'm not providing any additional insight on. But we have seen actually a cooling off of the housing market over the last month. And thanks to Jill Maslinsky at Advisor Perspectives for this chart. Shout out to them. They're very generous with their data and we love to use it. So current levels, we've actually seen a pullback in homes in the last month as far as growth in home family sales. They're still rising, but they are not doing what they were the past 5 to 6 months. So interesting there. Now, what we'll jump to is finally on this particular set of charts is the bond market. And the bond market is a great gauge of how inflation is actually felt by investors who buy things like fixed income securities and bonds. What you're seeing here is a chart of the spread or the difference in yields between a corporate bond, a typical corporate bond, and a 10-year government treasury bond. Now, typically when inflation is high, those spreads are quite wide because people are worried about the quality of debt they're purchasing from corporations. They're worried about the ability of that corporation to repay. Inflation eats away at bond values anyway, and so corporate spreads tend to widen versus treasuries. But if you are worried about inflation, it doesn't seem that the bond market itself is worried about inflation, because we've never seen these spreads as tight as we have going back in other periods in time. So it's nothing outlandish as far as corporate spreads, and they seem to be behaving like a normal bond market would behave. So you may be worried about inflation, but I can tell you the bond market as it's acting or behaving now just isn't. So a lot of people seem to think inflation is what an economist would call transitory or temporary. So interesting to watch, and it's worth noting as we move through the year. Okay, so let's focus on the stock market specifically and what that has done year to date and what might be in store coming up. No promises, of course, but we can take a look and make reasonable guesses as to how we feel things may go. So let's focus on the S&P 500. These are the 500 largest publicly traded companies in the U.S., or most of them anyway. We will go to a year-to-date chart on the S&P first and look at what the market has been doing. since January 1, year to date. So we are up nicely on the year. As many of you may know, the market has bounced off its trend lines routinely when challenged, and buying continues to come into the market. So we are not seeing inflation at all affect stocks. In fact, if you are afraid of inflation, then realistically stocks would be a better place to be than bonds, because bonds typically lose value during inflationary periods. So this is a very interesting chart to look at year to date. If you back out a little further, I'll go back to 2011, 2012, actually 2012. Our trend line continues to move higher after breaking out in post-coronavirus crash 2020. So every indication that this would probably keep going for the remainder of the year. There's no guarantees, of course, but with new money, we are selectively placing investments in the stocks, and probably would be recommending that for clients going forward. So if you have an existing financial plan that requires investments in stocks and in the market in general, I would not be changing those plans anytime soon. And one reason why is because of a lack of volatility and what typically happens after interest rate hikes. So I'll put this up here as well. It is a number of days the S&P was up or down by 1% relative to other years at this point. And last year, of course, was pretty volatile. We had a number of days where the S&P 500 moved up or down by 1% or more. But we are certainly not trending outside of any historical norms. This is typically what you see, and in most given years, 2020 being the exception. And certainly no reason for alarm in that respect. And of course, if you are concerned about inflation, I'll throw this final chart up here. This is just the average S&P 500 returns before and after an initial rate hike. This comes off of Bloomberg in chart form, but very interesting to see that rising rates typically do not affect the stock market negatively. So hopefully a little shot of optimism there if you're worried about the markets, if you're worried about inflation. Historically, the markets have performed relatively well in inflationary periods. Typically, that means the economy is recovering. Typically, it means that the economy is getting better, and stocks reflect that, and their returns reflect that. So I hope you find that optimistic. I hope that helps understand kind of where we are in the market right now, what is being talked about, being discussed. I hope you have a very nice July 4th. Enjoy your holiday, and all be safe. And thanks again for tuning in. Have a nice day.